Index funds have revolutionized the way people invest, becoming one of the most effective and accessible tools for growing wealth in the stock market. Personally, I've been investing in them for years, and it's no surprise to see why they've gained so much popularity in the last few decades. But while they're often praised for their simplicity, many investors, both beginners and experienced, still make very common mistakes when using them. So in this video, I'll walk through some of the biggest errors that I see, and more importantly, what you can do about them. Whether you're just starting out or looking to fine-tune your strategy, I'm sure there is something in this video that you may find useful. The first one is understanding the two types of index funds. This is a common mistake that's easy to make, but it's crucial to know. Index funds often come in two different versions of the same fund, which can make investing seem even more complicated. But don't worry, it's fairly straightforward once you know what to look for. Now, for example, take this popular Vanguard index fund. You'll notice something at the end of its name called DIST. This stands for distributing. A distributing fund takes the dividends it earns from the companies that it owns and pays it out to you as cash. These payments usually arrive every 3 months, and the more shares you own, the more dividends that you receive. And it's calculated as a percentage of your holdings. Now, on other platforms, it may not say distributing, it may say something like income. But if you're a long-term investor, you might not even want or expect these dividends, because instead you'd probably prefer to reinvest those dividends back into the fund that you're investing in, or even better, not even have to think about them entirely. And that's where this other version of the same fund comes in. Now, with the example we took before, there is another fund, but at the end of the name it says ACC, which stands for accumulating. And an accumulating fund just reinvests those dividends back into the fund automatically. So you won't have to do anything yourself or tinker with it, and that's incredibly convenient. Now, which one is right for you? Because it really just comes down to what your goals are. If you're using dividends to cover expenses like retirement income or monthly bills, a distributing fund may make more sense to you. But for people aiming to grow their wealth over the long term, keeping your money investing and allowing it to compound over time may be the better option. And the takeaway from this, always check the fund's name to see if it's distributing or accumulating. It's a very simple detail, but getting it wrong could mean you're not optimizing your investments to your specific needs. Index funds are a category of investments, but within that category, there are two ways to invest: as a mutual fund or an exchange traded fund, ETF. Both track the same index and everything inside the funds may look identical, but there are a few important differences that you need to understand. The first one is index funds as mutual funds. When you buy an index fund as a mutual fund, you usually need to meet the minimum investment requirement. For example, if you invest £100, you'll get exactly £100 worth of that fund. And mutual funds are bought and sold through an investment platform and are only traded once per day, based on the fund's official price at the end of the trading day. And the other one is index funds as ETFs. An ETF, on the other hand, is traded like any other stock on the stock market. Now, the price of one ETF, for example, may be £85. And if you want to invest £100, you'll end up with one share and £15 left over in cash. Now, this leftover cash often confuses people who expect that their entire investment to be used. However, with ETFs, you buy whole shares, which can then leave you with unused funds in your account. So to summarize, the mutual funds allow you to invest an exact amount, like £100, and then get that exact value in shares. ETFs, however, are purchased as whole shares based on the current market price, leaving you with this potential leftover cash. Now, fortunately, there are many newer investing apps, and they allow you to buy fractional shares, even for ETFs. This means you can invest the exact amount that you want to without worrying about having leftover funds. Mistake number 3 is overlapping investments. Now, I'm not sure if this is necessarily a mistake, but it's definitely something to be mindful of. You might start off with investing in a few different funds, but over time you gradually add more to the mix. And before you know it, you end up with half a dozen investments. Now, there's no definitive right or wrong way to invest. This is more just about shining a light on the topic and encouraging you to consider it a bit more carefully. As an example, let's take two different funds, the Vanguard FTSE All World Index Fund and the S&P 500 Fund. Now, on the surface, this may seem like a good idea because you're diversifying and spreading your investments globally, which is a good thing. However, if you mix these two funds, the Global Fund and the S&P 500 Fund, you end up putting more money into those large US stocks. This could work in your favor or it might not. There's no way to predict the future. But one thing that's important to recognize is that the global fund already contains many of these large US stocks, thereby creating a potential imbalance in your portfolio. The main thing to take away here is to really understand what your portfolio looks like when you have these multiple funds. Now, one oversight investors can make is skipping over the key investor information document. Now, this document is really important for conducting proper due diligence and just making sure you understand the details about the fund before you actually go ahead and invest in it. Now, whenever you click on an investment, you'll typically see a link to this document. Just be sure to open it and carefully read through its content. Taking a few minutes to review it can just help ensure that your investments align with your expectations and your financial goals. because if you do miss this out and don't read it, you might misinterpret what the fund is designed to do. This could lead to investing in something that doesn't meet your needs, or even worse, create a portfolio imbalance that you didn't want to have. Now, just an example to illustrate this point, imagine you're investing in a fund, such as this one. In the name, it has World ETF. Now, at first glance, you might assume that this investment invests in the entire world. However, if you check the fund's details, and the key investor information document, you'll see that it only tracks the developed world markets. And that is around 20 or so countries such as the US, UK, Japan, and Germany. Now, this might align with your strategies or it might not. The important thing is just that you're aware of this limitation before committing your money. Now, to avoid this mistake, just always check that document. Look for the sections that explain the fund's objective, the regions it covers, and the types of companies or markets it invests in. The document also contains details about potential risks the fund may have and any associated costs with it. It's there for your own benefit, just so that you can make a more informed decision. So those were just a few mistakes to keep an eye out for when investing. If you found that interesting, you might want to check out this next clip over here. Thanks for watching.